So UK wage data is coming softer. Now, will this be a cause for the Bank of England to pause? And we're going to have a look at whether the next big bet in markets is on lower interest rates, specifically in the UK, but could be translated to the US as well. And today's trading takeout is why we always need to refocus on what interest rates are doing. Now, the only way you can get the best trading insights, education, and analysis each day is if you're here every day. So hit subscribe so you can get your daily trading edge. So some slightly softer than expected wage data today. We'll start with the ex-bonus number. UK average earnings, August 2023 was 7.8% versus expected 7.8%. Previous was 7.8%, but the revision was 7.9%. And then the quarterly earnings, average weekly earnings, was 8.1% versus expected 8.3%. So a little miss there. Previous 8.5%. And then the UK HMRC payrolls change was down 11,000. Previous zero, revised negative 8K. So that's actually not very good data in terms of the employment situation. The labour market is getting much looser than first expected. Now, I'm not so much worried about the wage data here, because the way that I see that is inflation is disinflating. It's still increasing, but coming in at a slower pace. And so you're obviously going to see concurrent lessenings in the rate of change of wage growth data to catch up with said inflation. If the wage growth data were to be outpacing inflation massively, then there could be a broader issue. Or if the rate of change were increasing at a rate faster than inflation, then that could be an issue for the Bank of England. But looking at this, it looks like it's much, much softer out there, especially in the employment situation. Negative 11,000 jobs created, basically. It's a weird definition that you have to provide there, but basically employment is less, especially when you look at that revised figure, negative 8K. Now, if the previous was 0K, so nothing created last month, but the revised is actually 8K, could it mean that this month's figure is also a lot worse, closer to 20K? That would be a question that we'll have to look at for the next data. Now, with regards to how this influences interest rates and what the Bank of England are looking at, naturally the Fed had paused previously, and it's very important to recognise the relationship between what the Fed does and what the Bank of England does. If the Fed wants to pause, the Bank of England are likely to, at this stage anyway, also pause. Fed has their next meeting next month, but the Bank of England has one this month. And I think, what they're going to be looking at here is, okay, have we done enough for the meantime? And now what is our signal? My view is that they're seeing the labour market loosen. And so they're going to be thinking, okay, this is sufficient now to think that over the next couple of months, we're going to see wage data start loosening even further. Wages will start to, come off, basically. We'll start to see slower increases in the rate of change of wage growth. And so what that would mean is a softening effect on inflation, in my view. A lot of this at the moment is riding on if Ofgem are responsive to any upticks in energy prices, though, in my view. That is the one big risk here. And that could inspire, a real inflationary event again. However, I don't think there's anything likely. We spoke about nat gas yesterday. We spoke about oil last week. The demand just isn't there out into the further months. So my view is that won't be an issue. But if it were to be an issue, and this is why it's good to spell out the risks, that would be the biggest risk for me, if that makes sense. Especially with the geopolitical situation in the Middle East at the moment, and whether there could be a snap oil supply decision. So that is the way that I'm looking at things. I think the Bank of England would be weighing that up as well. But for now, the Bank of England's policy is working. It's working its way through. DINRA last week, she said that the rate hike cycle was only had only fed through about 20% of the effects, 20 to 25% of the effects through to the real economy. Now I think it's upping it. It's upping it to maybe 30, 35%. We'll see 5% increases in that over the next couple of weeks. Of course, that's a couple of months, sorry. Of course, that's subjective, though. There's no objectivity behind that. But we are in tightening territory. We're in constrictive interest rate policy now, rather than neutral or loosening. And so, it could be argued then that the neutral rate is at about maybe 4.5% to 4%, whereas the loose rate is below that. So loosening would mean that demand is stimulated, whereas constricted means that obviously demand is constricted. So I think that's where we are. I think the Bank of England are going to pause, which should mean that the pound sells off quite considerably. Not necessarily versus the euro, but I think the best play would be versus the yen and also the dollar here. So following on from our discussion just then about wage growth data in the UK labour market, I just wanted to take a look at VGov, which is a bond ETF listed in London, the LSE, and it basically tracks UK gilts. Okay, and I'm long this, and I have been since July, because my view has been that the UK is or has reached the terminal rate the second that the energy situation calmed itself down. And I say this because we had basically artificially inflated the energy price relative to what the wholesale price was. The energy price cap was sort of a scam at the end of the day. If you looked at the difference between the cost of energy from, say, I don't know, August, which is when it topped in nat gas, to maybe, May, July, the only thing that could have kept prices higher and made the cap viable was if the hedges that the wholesale firms had paid for were really, really that expensive. And there's definitely a case to say, okay, they really were that expensive. But I think the main component there was really that the energy price cap was able to keep the price per kilowatt much higher than what the market would have demanded, which is actually why the UK had higher inflation, in my view. I really do think that that is a main cause of it. And so if we look at, the relationship between bond yields, interest rates, and inflation, we can see that from roughly June, when it was mentioned that the energy price cap would start to be lifted, we've seen a flattening out of this ETF. And you can look at UK gilts as well. It will show that the bond yields had started to flatten out as well. But effectively what we're looking at here is, if you want to take it from a technical analysis perspective, lots of dojis, which mean indecision. This is on a monthly time frame as well. So this is a fantastic sort of signal to look at. Price opening and closing over the month at roughly the same price. It's been consistent, apart from maybe September, which had a marginal change, I guess. And what that's indicating is if the price of the ETF is being supported, then there's buyers. And if there's a buyer of a bond, the yield is going to come down, and that yield represents interest rates at the end of the day. So the market currently is betting on UK inflation coming down and bond yields also coming down, interest rates also having peaked. That is what it signifies to me. And it's probably one of the greatest risk to reward trades out there at the moment, in my view. Because if you take a look at where we've traded before, that down here is not even the low. We've actually formed the base, and we formed the base where we rallied from when it was basically when it was introduced to the low of the year or two after. So here's the support level, and we're currently at pretty much the third all-time support level after coming off of an all-time low, which was back at the LDI crisis, and we're not going to revisit that again. As well, this was Volmageddon back in 2018, which is when the Credit Suisse volatility product blew up and volatility just went crazy. And that also caused a low here as well. So if we want to think about, subjective footprints in the market, we're at the subjective footprints, initial low there, traded down to this low, formed the support post LDI crisis again, and then it's formed all of these supports. I mean, to make it, and then you've got the macro backing as well, which is okay. The Bank of England are looking to pause now; they're looking to not be as aggressive. So, my view is VGov is a great ETF to hold at the moment, even from just eyeballing it from a risk to reward perspective. You've got all of this upside potentially. Now, what this might mean though is QE again. That is the big troubling thing in my view, is that okay, what would facilitate a move in UK gilts all the way back up here? I'm not saying that's a target, but markets tend to trade where they've printed previously. What would be the conditions to facilitate this? Now, my view, it would have to be money printing again, as I've said, interest rates coming down quite rapidly, and also probably some sort of credit event which requires government bailout. Unfortunately, this is the world that we live in these days. Governments are very, very quick to go and print money and hand it out and do whatever. I don't think they'll do it in the same way that they did over the pandemic, where they hand money out to the real economy, but sitting on balance sheets, bank balance sheets, lowering yields, it should cause, an upwards drift in the bond price. So, based on where I think the Bank of England are positioned now, I think they're at peak rates, pretty sure they're at peak rates. And so, the risk to reward from bonds looks good still. Maybe not just yet. Maybe I'd wait until year end to look at this. I think the next 3 months are going to be quite interesting. But that is where I'm at the moment. Now, today's trading takeout, as it is most days actually, is to always refocus back onto interest rates. I can't stress it enough. It is the backing of every single market that you'll look at. It is a weigh-in mechanism of how things are priced relative to each other, how things are priced relative to a risk-free rate. Every model, every single financial model will involve an interest rate at some point as a benchmark. So you as a trader, an investor, you have to try and facilitate the understanding of where interest rates fit into your understanding of the market and what's coming next, your predictions. Everything is interest rate focused. So when you hold your view, try and have a picture in your head of what the different interest rates are doing, where the different central banks are sort of positioned, and try to come to a conclusion as to what the next 3 months would look like for any decision that they're going to make, because I can assure you it will help massively.